Is the real estate market on the brink of disaster? Warren Buffett thinks so, and his warning has everyone on edge. Imagine a $1.4 trillion storm brewing, ready to shake the foundations of U.S. real estate. What does this mean for homeowners, investors, and our economy? Today on No Money, we dive deep into Buffett's predictions and the imminent crisis facing the real estate market in 2024. This is a must-watch if you want to understand the potential fallout and how it could affect you. Let's unravel the storm before it hits. A storm is brewing. Warren Buffett, the legendary investor, has sounded an alarm about a major storm brewing in the U.S. real estate market. He warns of a debt-fueled tsunami worth $1.4 trillion that has already begun to impact the market. But this is just the beginning. The real impact is set to unfold in the coming months. Here's what Buffett had to say. Tom Seymour asked, Charlie Munger has warned of a brewing storm in the U.S. commercial property market, with American banks full of bad loans as property prices fall. Can you elaborate on what's happening in commercial real estate? How bad will the losses be, and what sectors or geographies look particularly bad? Will Berkshire be more active in commercial real estate as a result? Buffett responded, Berkshire has never been very active in commercial real estate. It works better for taxable investors than it does for corporations like Berkshire. But the hollowing out of downtowns in the U.S. and elsewhere will be significant and unpleasant. The country will get through it, but it will involve a different set of owners. The buildings don't go away, but the owners do. Over the cheap debt. For the last 15 years, the U.S. real estate market has thrived on cheap debt. Look at this chart of the U.S. federal funds effective rate, a proxy for interest rates in the economy. For the better part of the last 15 years, interest rates hovered around 0%, incentivizing massive debt use and pushing real estate values to sky-high levels. Imagine someone buys an office building for $1 million. The buyer likely doesn't have $1 million in cash, so they go to a bank for a loan. They might contribute $350,000 as equity, a down payment, and the bank lends the remaining $650,000. If the loan has a 5% interest rate, the annual debt payment is $32,500. If the building generates $60,000 in income, it can comfortably cover the debt payment. Banks evaluate loans using a debt service coverage ratio, DSCR, calculated by dividing income by debt payments. In this case, the DSCR is 1.85 times. Banks prefer a DSCR above 1.2 times. So at 5%, this property is profitable. The impact of rising interest rates. Now let's see what happens when interest rates rise. Homebuyers often get a 30-year fixed-rate mortgage, locking in the interest rate. Commercial property loans, however, reset every 3-5 years, adjusting to current rates. This reset can be devastating. If the loan's interest rate rises from 5% to 7%, the annual debt payment jumps to $45,500. At 9%, it skyrockets to $58,500. If the building's income drops to $40,000 due to lower demand, the owner can't cover the debt payment, leading to foreclosure. The bank takes the building, selling it at a loss. This is what Buffett meant when he said, "The buildings don't go away, but the owners do." Real estate's non-recourse debt. When you buy a house, you sign a personal guarantee, meaning you must repay the bank even if the house's value drops. This isn't the case with commercial real estate. Large properties are often bought with non-recourse debt. Here's how it works. A real estate firm buys a property for $50 million, contributing $10 million and borrowing $40 million. If the property's value drops to $30 million when the loan resets, the firm can walk away, leaving the bank to eat the loss. This situation is unfolding now, with $1.4 trillion worth of these loans due over the next 24 months. Many properties are worth far less than their purchase price, or they can't sustain higher debt payments. Early signs of trouble. Warren Buffett's warning about the brewing storm in the U.S. real estate market is already showing early signs of trouble. The problem started with years of cheap debt, which led to sky-high property values. However, as interest rates rise, many property owners find themselves unable to meet their debt payments. This is particularly true for commercial real estate, where loans are not fixed for the long term. Instead, they reset every few years, leading to significantly higher payments. For example, A $1 million office building with an interest rate increase from 5% to 9% sees debt payments nearly double. This, coupled with reduced income from properties like office buildings due to the rise of remote work, means many owners can't cover their loans. This is just the beginning, as many properties are headed for foreclosure, leaving banks to handle the fallout. The role of small banks. Small banks play a crucial role in the unfolding real estate crisis. Unlike large Wall Street banks, which focus on Fortune 500 companies, small regional and community banks dominate the commercial real estate lending market. It's estimated that these banks are responsible for about 2/3 of all commercial real estate loans. This means that as property values fall and loans come due, these smaller banks will bear the brunt of the defaults. They are left holding properties worth far less than the loan amounts, leading to significant financial losses. While these banks are essential to local economies, providing loans to small and medium-sized businesses, their weakened financial state will likely force them to pull back on lending. This reduction in credit availability will have far-reaching consequences, impacting business growth and local economies. Economic ripple effects. The ripple effects of the real estate market troubles extend beyond just the property owners and small banks. The broader economy is at risk as well. Small and medium-sized businesses, which rely heavily on loans from small banks, will face significant challenges. With these banks taking financial hits from real estate loan defaults, their capacity to lend will be reduced. This means that many businesses will struggle to secure the capital they need for expansion and growth. Without access to loans, these businesses may cut back on hiring, slow down their operations, or even shut down. This will lead to higher unemployment rates and reduced consumer spending, further dampening economic growth. The interconnectedness of the banking sector and the broader economy means that the impact of the real estate market troubles will be felt widely and deeply. Final thoughts. The real estate market's future is uncertain, but pain is inevitable. As Buffett's partner Charlie Munger said, there's going to be a lot of pain. The question is, who will bear it? So, there you have it. Subscribe to No Money to become a better investor by studying the world's greatest investors. Stay informed and be prepared for what's ahead. Talk to you again soon. Thank you for watching this deep dive into Warren Buffett's warning about the real estate market. If you found this video insightful, please like, share, and subscribe to No Money for more valuable content. Let's navigate these turbulent times together and make informed investment decisions. Until next time, stay smart with your money.